What is up, kiddies? Hope you had an amazing summer weekend. I am flying solo dolo today, so let's review the top 3 things you guys need to worry about from a market standpoint, a trading standpoint, and a news standpoint for the macroeconomics this week. First up, let's talk Israel-Iran. Now, in the past, okay, every single time you have had a major push-up into extended selling supply, like so in February, is because institutions are pivoting from risk assets to more high value and less risky asset classes like bonds. Look at the 10-year and notice how we had a triple top on the macro. Once yields triple topped, institutions started pivoting aggressively to buying bonds. This sends bond prices higher and bond yields subsequently lower. As bond yields decline, okay, and bond purchases pick up, remember, buying bonds has an inverse effect to buying equities because bonds are more of a value play guaranteed by our government at a specific interest rate or yield. And this is why the sell-off happened leading into April. So when everyone on television tells you that it's because of Trump's tariffs and inflation, that was the reason why the sell-off actually began, it's not 100% true. Yes, the April 2nd, Liberation Day, added to an acceleration of the sell-off, but institutions were clearly positioning for it when Trump was inaugurated. So we sit here now, double topping at the same exact supply level, okay? When this first supply level was created, the majority of this was selling volume. It is now flipping to buying demand, okay? They're turning resistance into support after this dip. So anybody waiting for some tumultuous news to come out of Israel or Iran and to send this thing back to hell, it's not happening. Supply is now turned into demand. This majority zone is now more buying demand than selling supply. The effects of that is going to be a market that continues to plow higher no matter how your feelings are or what you think about the news and war in the Middle East. It just doesn't matter. Quickly, going into the zone that we are specifically into with quarterly June OPEX just clearing out. That is over $15 billion plus in hedges from institutions that are being dealer delta hedged so they can stay delta neutral. Okay, all those trades are now cleared out. They are moved to the next quarterly and roll to September OPEX, which is your next major OPEX date. This is your next trip witching date as well. This is where newbies that don't understand are where the majority of your derivatives trades clear if you're an institution, asset manager, pension fund, hedge fund, insurance firm, etc. This is where you're placing your hedges to protect yourself from equities and the false risk on environment that we are currently in. Once your window of weakness approaches and Van and Charm decay come to a crawl, especially after quarterly OPEX dates, okay? The market is in its most vulnerable position it could possibly be in because the next pull for Van and Charm is 3 full months away. It does not affect the market in a positive way. The only way they can pull this market up through window of weaknesses is by scheduling events like Mag 7 earnings or an Apple conference or Trump talking. But behind the scenes, fundamentally, what is going on is collusion between the biggest and largest whales on the street that have the most money that are working together to use the options chain and keep the market plowing through into your next window of strength, which starts in July, your first week with non-farm on the 3rd. That is when your dealer flow window of strength heats back up again. Also, let's tackle this oil chart quickly because usually in times of war, the price of oil is supposed to spike, as you saw over the weekend on Saturday when Trump attacked Iran with the B-2 bombers and the price of oil jumped nearly 6%. But it jumped nearly 6% into what? Jumped nearly 6% into massive, massive super macro resistance, okay? Here it was support before COVID, but it is now resistance on the super, okay? And you have to take that into account. This is a algorithm. It is moving based off supply and demand zones. It's not moving based off war news, okay? The algorithm does not care what the news is. The news comes after the fact. The chart is set up with supply and demand zones measured by Fibonacci levels as your map and guide, and an algo liquid tests those supply and demand zones as so. Usually in any time of war, you're supposed to see oil spike. And what happened as Iran retaliated against us today on Monday? It dropped right off that supply zone, 11%. Trade the chart. The chart doesn't lie. Next up, how many Fed speakers do we have this week? 20. Okay, this has to be some kind of record. Anytime the market is setting up news events in the window of weakness, just like this, you can expect the S&P to continue to move higher. Thirdly up, major news this week. The only two things that I care about is Powell talking on Wednesday and PCE coming in on Friday. Now, why is PCE, especially core PCE, so important? PCE tracks various goods purchased in the household that evolve over time. This is captured in real time as opposed to CPI, which is more of a static basket of goods. You're talking food, housing, transportation, and clothing. Now, the CPI data that comes in can be more volatile because it's not tracking real life trends. It's also not taking into account all the little things that houses purchase on top of business expenses and things like health insurance. Because CPI is a more narrow view of where inflation truly is, the Fed prefers to use PCE, which comes out in the last week of every single month. And this is what they've been going off of. Now, if you look at the PCE numbers that have come in since January through May, they're pretty static year over year around that 2.8 to 2.6 level, okay? While inflation is generally coming down on CPI on a month-on-month basis, on PCE, the year-on-year inflation numbers are pretty static. This is one of the main reasons why Powell does not want to lower rates. He's going to keep you plugged at 4.25% to 4.5% until something crazy happens to the labor market where we see added cracks that extend further than just the private sector. And with unemployment numbers cruising at a cool 4.2% and not really budging or extending higher, there's just no reason for the Fed to cut rates at this point in time. Besides that, guys, finally, we really are just expecting the market to continue to plow higher here. There were ample chances and multiple micro and macro POIs in this window of weakness for the market to pull back. The fact that the Iran on Saturday, oil prices spiked, weekend futures were down, and nothing happened to the S&P at all today. It bounced back immediately right off 591. There is just nothing stopping the collusion behind the scenes from market makers, dealers, institutions of the largest sizes to continue plowing this thing higher using delta hedging, using gamma, using positive delta, and basically pulling the market higher to strikes that are going to be extended all the way up to the 640 level leading into the end of the summer, okay? So don't expect this gap to fill anymore. It had its chance. There were over 100,000 calls at that 580 level that were supposed to get wiped out leading into OPEX, but didn't because those institutions moved their positions over the Juneteenth holiday. This is not happening anymore. Forget about it. We are going like this, sideways through the week. We're going to blast right through the 4th of July holiday to new all-time highs afterwards, leading into July OPEX because you have that new Van and Charm pull from dealers, and this thing is not going to stop until you get to a minimum, and just take your standard fibs. You don't have to make this too complicated. Remember, when you're taking fibs, this golden pocket on the mid-range is where you want to make sure that you're taking a little bit off the table, okay? Have a good week, guys. Kill it, and I will see you with an educational video this Thursday.